Hello everyone, chessNwine here. I hope you've been following me on Twitter and StockTwits, as well as following my posts on ibankcoin.com, as well as my own personal website, doublediptrader.typepad.com. Well, I know it's a Friday afternoon, so I figure I would do a video market wrap-up of my SPX S&P 500 chart here, which I update daily for you. Obviously, I think it's incredibly important to be cognizant of the broad market moves, given the fact of how many stocks move in concert with the broad market. And I do think that the S&P 500 is a better gauge of the broad market, more so than the Dow Jones Industrial Average. So that's why I show you this chart. Basically, the daily chart remains very healthy, very constructive. Today we made a new 52-week high, albeit a marginally higher high. But nonetheless, by about 3 or 4 handles, but nonetheless impressive, healthy, and constructive. Over the past week, we've had some backing and filling. We've been in this neutral consolidation range, and twice, as you can see here, on Monday of this week and then Thursday of this week, we came down. We slightly broke down below this trend line of the rally since February, the pink line, and we tested the 20-day moving average, this blue line here. Both of those tests were successful. And then we moved back up and made a new marginally higher high. And that's impressive. I mean, if the bears were going to take this market down, and they had every opportunity to after that Goldman Sachs news last week, they had every chance to. They had all the reason in the world to. Goldman Sachs news, the Greek news, whatever you want to call it, and each time they lost the initiative. So that shows you that the market wants to go higher. We're still in this overarching void or vacuum up to the summer of 2008 area of supply we should see, which again is anywhere from 1220 to 1300. It's kind of this broad range. And recall, that was the last stand of the bulls in the previous bear market. I know that's kind of wordy, but think about it. Before we had that final crash in 2008, October of 2008, and of course we had that long bottoming process after that. But before we went over and had the last leg down of that bear market, the bulls made a final stand, kind of the last bear market rally we had in the summer of 2008 after the Fannie Mae Freddie Mac bailout. And that because of how volatile things were back then, with the S&P moving 30 or 40 handles in any given session, that range is anywhere from 1220 to 1300. So once we get up there, I believe we really are going to need some more volume on the bull side to get us through that range, because that's going to be pretty tough. Because keep in mind, all of those bulls who bought during that rally, that suckers rally turned out to be, they're finally going to be made whole after about almost 2 years of suffering. So that's something to be aware of. But until we get up above that point, we're still doing well here on the daily chart, and things are pretty constructive. I mean, we're at the lower end of the trend line of the rally since February. So to argue that we're kind of at this blow off top, that we're at the top of things are like they were at the top of the NASDAQ in the year 2000, like I've heard many bears argue, I think is hyperbole. I think we're doing well. We're doing okay here, and I think you can still have some longs. But again, keep in mind, we are in earnings season, and therefore, as I've been almost preaching the past couple weeks, it's okay to have a higher level of cash than usual on hand. But again, I would not be short here, other than for some day trades or kind of some small hedges. But to be short right here, I think you're fighting the tape, you're fighting the trend, and I don't think it is a profitable risk-reward strategy. So again, my best strategy right now is to have some select longs in names where you think the charts are looking very good and have good individual setups, and then a decent, pretty healthy size cash position. Next week, obviously, you'd like to see some follow-through from the move we had today, the new 52-week high that we made. It could easily turn around and we could reverse, but anything can happen. But overall, you have to respect the trend, and the trend remains higher. And that's really all there is to it. Until the market gives you a reason to go short and completely sell out of your longs, don't take the bait. I mean, you're always going to have bears every single day calling a top, or even scared bulls calling a top. But again, as I pull out to the broad market range here, look, this is the trend, and the trend is higher, and every single dip we've had should be bought. So overall, a good day, a good week, and have a great weekend, guys.